So we heard a lot of really interesting conversation, and to me, I'm just observing that things have moved along quite significantly. We're not looking at whether renewables or new technologies work for mines, whether they're reliable. We're sort of moving away from the discussion around affordability and economics and really looking at some key drivers that are really coming from the top in terms of the focus on carbon mitigation. So it's a very exciting space, and certainly I've really enjoyed hearing the discussions so far. So now we're going to sort of move on to really what's at the heart of this whole market, which is the fundamentals, the numbers in terms of where we're at in the business cycle for mining, where we're at in terms of renewable energy, where those two meet, and how we're seeing the drive for these technologies change, the demand for these technologies. So it's my pleasure to introduce the session chair. Bonnie Hiltz is Director for Power and Utilities at Sussex Strategy Group. She has a breadth of experience, a breadth of policy experience across several sectors, both locally and abroad, and was part of the team responsible for Ontario's renewable energy policy development, ranging from the first renewable energy supply procurements right through to the feed-in tariff program, and we're delighted to have her chair the session today.
Thanks, everyone. It looks like we lost a few people at lunch, so I don't know if that's people busy kind of getting some work done or maybe taking a quick cat nap after lunch, but we hope to bring them back for this session. I think it's going to be a very interesting one, and I've heard people talking all day about, we heard a lot about kind of carbon pricing and policies, and as Adrian said, this session really is our chance to talk about the numbers, because at the end of the day, that's what it comes down to. So the session today, we have 4 speakers. Each of them will be talking about prices, price trends forecasting for the kind of near, medium, long term for various drivers in this sector. Each of them, just logistics of how it'll be run. So each of them has about 20 minutes to make a presentation. During which time you'll all be paying attention very closely, writing furiously, and especially taking notes on questions you have for our presenters, because after all 4 presenters have made their presentation, I'll be inviting them all back up here for an interactive Q&A session. So members of the audience, please take note of your questions as the presenters are speaking so that you can be actively engaged and present them and get all the answers to the questions that you have. So with that, I guess I'll launch off with our first speaker. So Rory Johnston, with whom I had the pleasure of having lunch, we coincidentally sat at the same table, and I heard a little bit more about what he does. So he's the commodity economist with Scotiabank, and he focuses specifically on mining sectors, agricultural sectors, and energy, so Canada's export markets. And so he's going to talk a little bit about commodity price forecasting for us. So please welcome.
Thanks so much. And it's smart to start with the economists because they always bring big crowds. So my name is Rory Johnston, and I'm here to kind of give you a very brief overview of how I see different metals markets, evolving over the coming 2 to 3 to 5 years. So I think at a headline level, the macro backdrop in which we find ourselves is important when differentiating between different major segments of mine commodity prices for forecasting purposes. On the left-hand side here, we see that for the first time since the Great Financial Crisis, every major global economy is either growing or seeing its economic growth accelerate. This is very supportive of the entire metals complex, and in particular on the base metal side, given that a lot of this acceleration in growth has actually been seen in the advanced world. So this is going to support the use of copper and nickel and other base metals in higher end and advanced manufacturing, as well as consumer electronics, things like that. Juxtapose this next to the chart on the right, which shows that the Chinese economy, and particularly the Chinese real estate sector, is beginning to slow down, which is what we generally expected to see as you see the credit stimulus start to wane. So that's that dark blue shading there. As that credit begins to kind of contract in terms of the direction of its growth, we see that housing prices are falling off as well. And with housing prices, so goes construction activity. With construction activity, so goes the steel industry and imports of iron ore, et cetera. So that's the kind of macro backdrop from which we're going to analyze the base metals and the industrial bulk commodities. So broadly, I see base metals outperforming and the bulk commodities kind of taking a breather, and while not declining outright, likely staying at roughly flat for the next 3 to 5 years. So as you can see here, the best performer in the near term is going to be zinc, which is in our minds the furthest along its rebalancing cycle, but it's likely going to peak within this forecast horizon and start to decline back down as more mines come onto the market. Contrast that with the copper and nickel, which we generally just see climbing through the forecast horizon, and the aluminum's a little bit flat as well, and I'll talk a bit about that afterwards. So starting with the base metals, we've seen a tremendous rally this year, which in large part was both because of tightening of supply and demand in a fundamental perspective, but also because these metals are benefiting from that broadly supportive global economic backdrop in which we discussed. The metal that's taken this bullish base metal outlook most to heart is kind of the poster child for the base metals, copper, or Dr. Copper as many like to call it. But I actually think that within the base metals complex, this is the metal that's actually gone a little too far, too fast. So while we do see a lot of strength for copper going forward, we do believe that the recent rally has been a little too much, and we're likely to see prices come back down before they start to rebalance and strengthen going forward. So there are a couple of reasons for that, and this is just some of the indicators I watch to kind of assess. It's a little bit of a sniff test to see what's really going on in this rally. So the rally in large part was driven by a large build-out of speculative long positions, all on this rebalancing global economy, strengthening global economy, and strong general industrial production numbers out of China. But as the price rose with these speculative positions, we've actually seen the contango of the copper contracts extend precipitously. So what you would typically expect to see in a really tight market is the market flip into backwardation, where prices today are more expensive than those further down the road, because that means that people are paying a premium to get a hold of what they can right now, and that's really what's going to tell you your near-term tightness. Also on the inventory side, well, we have seen inventories, this is the bottom right-hand chart, as we have seen inventories kind of come down a little bit, which has been supportive of that overall bullish copper rally. I do generally think that inventories still aren't anywhere near low enough to have prompted the type of fundamental driven rally that we've seen. And there's a lot of funniness, as you can see, particularly on the LME stocks, that dark blue at the bottom. There's a lot of choppiness as different market participants are trying to play these spreads. So it's a lot more inventory arbitrage right now than a fundamental rebalancing. So we do think that is going to, that after copper comes back down from about $3.20 a pound right now, nearer to $2.85-ish, for next year, we do then see continued global growth, continued demand growth, and an emptying of the copper mine supply pipeline, kind of emptying, and then prices are going to strengthen up above $3 and well above $3 in the first half of the 2020s as we really start to see that tightness work through. Compare and contrast copper with nickel, which is actually seeing a very large deficit today. So if you see here on your left-hand side that red line, we're actually in very sizable deficit territory today, but nickel's dirty secret is that this acute tightness that we're seeing today is coming after over a decade of surplus production. So as you can compare to the other, copper, zinc, and aluminum, where all their exchange inventories have declined fairly steadily over the last 3 to 5 years, nickel's actually gone the other way, and you've seen astronomical levels build up on the exchanges, and this is just what's visible on exchanges like the LME or COMEX or the Shanghai Futures Exchange, and there's likely at least that much, if not double that much, nickel hanging around off exchange. All of this will need to get worked down before prices can really start to come up, but in the longer term, With low prices today, very little interest in new mines, we are seeing that tightness that will bring nickel prices much higher into the 2020s, and further supported by nickel's battery connection. So this has been the big news at LME this year. Everyone's talking about nickel's battery connection. The anecdote that I often share is that Elon Musk often he says that while people call them lithium-ion batteries, they really should be called nickel graphite batteries in terms of that's what's actually really in the battery in terms of the overall mass of it. So as on the left-hand side, this is our general base case outlook for electric vehicle penetration, which if this comes to pass, it's a moderate view in between the IEA's 1.75 degree forecast and the forecast of some of the oil majors kind of in the middle. That would, just from EV batteries alone, increase base nickel demand by 35% over 2015 levels, and that's not even counting for all the other battery applications that we could see, whether that's on-site mine storage, like we're talking at this conference, or grid storage, or consumer electronics. This is just from EVs. So there's lots of good things to come for nickel down the road, but it's going to take a while of very large deficits today to work that inventory down that we've built up over the last decade. Moving from nickel to commodity zinc, which is also seeing very sizable deficits in concentrate supply today, but you also have very, very low inventories by historical standards. So we're at decade lows for exchange-listed inventories of zinc. Zinc prices have switched into decided backwardation. This is going back to our conversation earlier about copper, where we saw contango emerging, and now you're seeing very, very sizable backwardation as people struggle and scramble to get zinc metal today. This has been primarily caused by a very long period of low prices and underinvestment, the closure of a lot of high-profile and very productive mines at the end of their life. As the price rallied, we saw a brief little bit of an uptick in Chinese supply, which spooked the market and caused that final collapse in price we saw. But in that light blue line on the left-hand chart there, you can see that after that price, after you got that initial boost of supply, it proved to be short-lived, and we actually contracted fairly markedly after that. On that right-hand chart, that's actually one of the clearest ways to see the deficit in the concentrate market. So the actual, before it even becomes metal, the stuff is coming from the mines. There's an inverse relationship between the treatment charges charged by refiners and the availability of concentrate. So we've fallen from upwards of $200 a ton in 2015 down towards benchmark treatment charges of $20, and even mixed stories of smelters in China actually accepting negative treatment charges, paying mines to take their concentrate and turn it into metal just to keep the factories running and the throughput coming through to keep everyone employed. So there's lots of scarcity in the zinc market, but we do expect those prices to push upwards on an average basis to a peak of about $160 a pound in 2019 before gradually coming back down as those high prices incentivize new mines in the market. Finally, within the base metal sector, aluminum is a market that has seen a lot happen over the last year. It was often considered the most boring of the metals because the market was in many ways fundamentally broken by Chinese subsidies to the aluminum smelting industry. So what you saw over the last couple of years is a bifurcated market emerge. You see large surpluses of supply in China and large deficits of supply everywhere else as the prices fell low enough that a lot of other aluminum smelting capacity globally actually idled and cut back capacity. So now what we're seeing is a move towards what I call the blue sky policies in Beijing, policies that are aimed at reducing the capacity utilization of emissions-intensive production, and at the top of that list is aluminum smelting. So as you start to reduce aluminum smelting output to reduce the coal emissions that would fuel it along particularly what they call the 28+2 large industrial cities along the East Coast where a lot of the population is, that is starting to ripple through the aluminum supply chain, tighten markets both directly for aluminum in China, but also for a lot of the precursor elements, so alumina and carbon anode and other things that are actually going to spill out globally. So while we do see, it appears that deficit could be shrinking in China, the surplus could be shrinking in China, the question is, how high do prices have to raise in order for non-Chinese smelters to really pick up and start filling that gap? And we think that that likely needs to be nearer $1 a pound relative to our forecast of nearly 90 cents a pound going forward. So what's difficult right now is, while most of the other commodities we can see a very organic rebalancing path driving their price outlooks over the near term. With aluminum, it's very much it's a policy question. It's how tight are the effects of the blue sky policies in China? How much effect do they have on the precursor elements? And if they are as serious as they are saying, then our aluminum price forecast is going to be a bit light, and we're likely going to have prices nearer $1 a pound. However, if they follow more of their historical trajectory and it's a little bit more of a weaker enforcement mechanism, we could see prices fall back down towards 85 to 90 cents a pound as more and more of that production shifts west away from the population centers. So finally, moving and contrasting the base metals, which see generally a good amount of positivity in them, the bulks are a little bit, have a little bit more of a dour, range-bound outlook, and that's most clearly seen with iron ore. So iron ore saw a bunch of rallies very recently as extreme profitability of Chinese steel producers pushed imports of iron ore to all-time highs as you tried to push out as much steel to satisfy a domestic deficit. However, as I showed at the beginning, you see housing prices starting to decline down, and housing prices on that left-hand chart you can see are very connected to the price of steel rebar and the incentives that these domestic producers are receiving for their steel, and that's what's driving your iron ore imports. Now that we're seeing, on the right-hand chart, as we're seeing activity slow, sales are slowing, starts are slowing, and imports are slowing as well. And this is starting to weaken the seaborne iron ore market, which had been so strong earlier in the year. Much like the base metals, we're coming off a period of large supply growth, but with a weakening supply growth outlook going forward. But unlike with the base metals, where we see demand continuing to be strong and lots of robust support from the demand side, with iron ore, it's likely going to be a question of weaker demand growth, if there's any demand growth at all from the seaborne market, which comes down to a question of supply rationalization. So while we've seen most of the new supply come from low-cost, high-efficiency producers like Australia and Brazil, China is going to be the producer that has the most flexibility to prices. And as we saw on the right-hand chart, as prices spiked earlier this year, you saw a lot of Chinese mines that had been shut off and idled, smaller, lower efficiency, lower quality mines. They roared back into action, and we're seeing that fall off again. Prices are going to need to stay low enough for long enough to push those producers out more or less permanently, because the market isn't going to need the lower quality ore they're producing. As a comparison, the benchmark iron ore contract is about 63% iron ore, 62 to 63%. The main production that's coming out of China is near 18 to 20% in terms of iron concentration. So it's just a much lower quality feedstock that has a higher cost production associated with it. So that's what we're likely going to need to see shed from the market before the market can ultimately rebalance and move higher than $60 going forward. So that's my price deck, and I look forward to your questions afterwards. Thank you so much.